Thank you for joining today's webinar on the Tax Cut and Jobs Act of 2017. My name is Hank Kim, and I'm the Executive Director and Counsel for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In today's webinar, we will be reviewing the provisions of the TCJA that impact public pension plans, states, and individuals. Many have described the tax bill as the most significant tax change since 1986. Yet, it was completed in record time with no input from the minority party and never received a hearing. Thus, there are many questions unanswered, drafting errors, and unintended consequences to clarify. To begin to answer those questions for the public plan space, we have today Charles Purcell and Wanhan Cheng, partners at K&L Gates. We encourage audience participation. Please submit questions by using the GoToMeetings portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Charles, Wanhan, I'll turn over the webinar to you at this point.
Thanks, Hank. I will start out, and then Wanhan will cover some other material after I do. So just to reiterate what Hank said, the tax bill, the Tax Cuts and Jobs Act, was signed December 27, 2017. It was a rapid process enacting this. It's comprehensive, but at the same time, it is in many respects extremely unclear. There's quite a bit of talk within the tax community about what things mean. People are trying to figure out the bill. And actually, the IRS and the Treasury are also trying to figure out the bill. There is likely to be a fair amount of activity on the tax front over the next year. There are a number of technical corrections that need to be made in the bill. And so these there will be quite a bit of guidance from the IRS as well. There were a lot of unintended consequences in the bill. For example, there's a provision that's caused quite a bit of consternation in the agricultural community because it essentially permits farmers to avoid paying tax on income they derive from selling to a co-op. Again, not an intended consequence, but one that's very important to a lot of folks. I would encourage people to be very active in talking to their elected representatives, just because it's a very fluid situation. And to the extent that you have concerns about the bill or concerns about other things that might be enacted, I think it's very important to be talking to your senators and congresspeople. Now, just what are the major themes in this tax bill? It really has changed the landscape in a lot of ways in terms of the way the tax law affects people. For one thing, we have the most significant spread between corporate and individual rates since 1982, actually since I began practicing. This will cause a number of changes in the way that folks structure their businesses. Another thing that's very interesting in the bill is that you find different tax treatment for taxpayers receiving the same or similar types of income. And you'll see this as we go through the presentation. This is especially evident in the foreign side, but also in situations like real estate businesses. There will be increased complexity in structures for transactions. We're seeing this already after only a couple of months. We're seeing much more complicated structures because of the fact that different taxpayers are subject to different tax treatment. What I've heard is that it's very important to like your accountant these days because you'll be spending a lot of time with them. Now, the other thing that is very important about the Act is that, as you know, the Act was structured with the constraint of it not increasing the deficit by more than $1.5 trillion. Accordingly, there are quite a few phase-ins and phase-outs for the provisions we're going to talk about today. So not only is there different treatment for different types of taxpayers, but there's also different treatment from year to year on a lot of these transactions, on a lot of these provisions. And finally, there are really very significant changes for foreign-related transactions. We're not going to spend a lot of time talking about those. There are a number of slides on this that folks can review if they like. But this really is a sea change in the way that foreign transactions are treated. So what we're going to go through is first talk about the provisions that affect tax-exempt entities, then talk about the taxation of pass-through income, the benefits that are allowed to especially real estate investors. Then talk about some of the compensated and related issues, interest, depreciation, and net operating losses. And then finally, we'll spend a few minutes on the foreign-related provisions. We try to focus on provisions in this presentation that will affect tax-exempt entities in their operations and also in their investments. And some of the new rules on interest and depreciation are going to be very important for commingled investment vehicles. So first, on tax-exempt entities, what was not enacted? Well, one of the proposals that was in the bill initially was that UBIT would be applied to the income of public pension funds. Fortunately, that was not enacted, although apparently it is still being considered by some of the folks in Congress. The exclusion from income for tuition reductions for employees and graduate students that apply to universities was retained. There's a lower tax rate for distributed income for private foundations, which was important for well-run private foundations. UBIT was not expanded to include royalties on names and logos. And 501c3 organizations are still permitted to issue tax-exempt bonds. Finally, the deduction for student loan interest was retained. Now, what was enacted? There is a new excise tax on excess compensation of employees of tax-exempt entities. This is a new 21% excise tax. It's not UBIT, but it's an excise tax that's imposed on applicable tax-exempt organizations that pay compensation to any covered employee in excess of $1 million. And this is one of the provisions that's very important to tax-exempts. It's also one where there's a lot of unclarity. And that is specifically in the question of what is an applicable tax-exempt organization. So it's very clear that this includes 501c3s, farmers co-ops, and then it also is meant to apply to organizations exempt from tax under 115.1. Now this 115.1 exempts income derived from any public utility or the exercise of any essential government function and accruing to a state or any political subdivision thereof. So how does this apply to state entities? Well, that's one of the unclear parts. A public university typically, for one thing, may be treated as both a part of the state and a 501c3 entity. Based on my work with public universities, most of them have requested 501c3 rulings from the IRS and thus are treated as 501c3s under a special provision of the code. even though they may be part of the state and really don't need that. If they have gotten that ruling, it looks like they would be subject to this new rule on excess compensation. Now, what about states themselves? The IRS has ruled that states themselves are generally exempt from tax under an intergovernmental tax immunity doctrine, so that entities owned by a state and the state itself are treated as different entities. So how does that apply to organizations that are owned by the state? It's not entirely clear. To the extent an entity has gotten a 501c3 ruling, there's a risk that these new rules would apply to that entity. But you sort of have to look at this on an organization by organization basis. And there has been some talk about some organizations such as state universities giving up their 501c3 status. Again, not necessarily needed, except to the extent that you're trying to talk to donors about making a contribution. So, given the unclarity of who this applies to, this is something you need to be talking to your advisors about, just to make sure that, to the extent you have an issue under it, that it's not applicable to you. Now, who, in terms of employees, does this apply to? What the provision does is look at one of the 5 highest compensated employees of an organization. Again, if it's a state university, it's probably the president, the basketball coach, the football coach would be in that group. You do not take into account compensation paid to medical personnel and veterinarians for medical or veterinarian services not subject to this rule. So that to the extent that you have a public hospital that's run by the state or by a university, the doctors and vets will not be subject to this rule. Now, another thing that's important about this is that compensation from related organizations is aggregated. So, for example, if the university pays its president $600,000 and the State U Foundation also pays her $600,000, the aggregate compensation is subject to this rule. Okay. So, and this specifically applies to any covered employee that makes more than $1 million. So this is generally not a problem for a lot of state organizations other than universities. So the other part of this, though, is something that could apply to almost any organization, and that is severance payments. These are called parachute payments under the Act, and that is a separation payment to a covered employee whose total amount payable as a severance payment exceeds 3 times such person's average annual compensation for the prior 5 years. Now, payments to qualified plans are not subject to this rule, but any other type of severance is. And this is not subject to the $1 million rule, so that as long as it's greater than the 3 times amount, you can be subject to this excise tax. Now, why is this being enacted? Well, part of the reason is that the Congress was taking ideas that are used in other contexts. The first being is that compensation paid to employees of public companies is subject to this $1 million limitation, in that you cannot pay your 5 highest employees more than $1 million and deduct it if you're a public company. There were some changes to this that provision as well, which we'll talk about shortly. And I think this is going to be very important for public companies, maybe perhaps more so than states. But they took the concept that applied to public companies and then applied it to all tax-exempt organizations. So that's where that idea comes from. The tax on parachute payments applies to severance payments on corporations that are being sold. So golden parachutes, in a word. Again, the concept came out of a concern that employees of companies that were being sold were taking out inappropriate amounts of compensation. And it was shifted to tax-exempt organizations, but applied to all of these tax organizations. Where, obviously you're not buying and selling tax-exempt organizations, but it applies to all severance payments that are made. And again, why was this taken out of those areas? A part of it, I think, was just to generate more revenue. They needed to stay within the 1.5 trillion, and so a lot of provisions in the new law, which seem a little strange, are there just to increase revenue. So, and one of them is another provision, which is the excise tax on investment income of large educational institutions. And this applies to tax-exempt organizations that are not public entities. So it only applies to large private colleges and universities. The rules that apply to these universities are set out in the slide. I'm not going to go over them. But this will apply to, they say, about 20 universities altogether. Now, for this purpose, assets of related institution are taken into account. This only applies to educational tax exempts. It does not apply to any other operating foundations. And state universities are specifically exempted. The tax itself, again, is based on an idea that applied in another part of the Internal Revenue Code. There is an excise tax on investment income of private foundations. The purpose of this was, when that was enacted back in 1969, was to provide revenue to the IRS to enforce the private foundation provisions. Again, the concern is that the private non-operating foundations are they're closely held, they're run by the donors, so it's very important that they be supervised. Again, this 1.4% excise tax is a revenue raiser. So, as opposed to having a specific purpose like the 4940 excise tax. Additionally, the Tax Act made some very significant changes to the unrelated business income tax rules. And there will be quite a bit of planning for entities that are subject to these rules, including state universities. Under the UBIT rules, income from each separate trade or business is subject to the unrelated business income tax is computed separately. So that if you have a real estate business and then you have a hedge fund, you cannot combine the gains and losses from those two entities. So it will, I think, raise the tax on entities that are subject to the UBIT rules. And again, this is a provision that's very unclear. We don't know what a separate trade or business is. For example, if a tax-exempt entity invests in 5 real estate projects, are each of them a separate trade or business, or are they treated as one real estate trade or business? Not clear, just not clear from the provision, and I don't think anybody has provided any guidance on that as well. Another provision that I think will be very important for a lot of entities is that essentially unrelated business taxable income is increased for disallowed certain disallowed fringe benefits. They changed the code to provide that qualified transportation fringe benefits, for example, transit passes and parking, are no longer deductible by taxable entities. Now, in addition, expenses in connection with certain on-premise athletic facilities provided to employees are not deductible. Now, 512 was amended to include in UBIT any expenses of a 501c3 entity relating to these benefits. So that to the extent that a 501c3 passes out transit passes to its employees, there will be a excise tax on the value of that, or rather, it will be UBIT on the amount of that is the value of those passes. Now, one thing that's very unclear on this is how it applies to parking. If you have a parking garage, do you look to what the value of a parking space is in the locality, or do you look to the actual costs of owning the parking structure and then take a portion of that and pay UBIT on it? Again, not clear at all. So, those are the major provisions that apply to tax exempts. We're next going to talk about changes for pass-through entities, and Wanhan is going to take that on.
So the next few sets of slides talk more about rules that have more general applicability. They may not have a direct tax impact on tax-exempt entities because of their tax-exempt status, but they could have an indirect effect because of the applicability of the rules to parties that do business with tax-exempt. And again, Charles mentioned earlier, our focus really here is, the status of a tax-exempt entity as an investor, whether it be in a commingled fund or some kind of joint venture relationship or a partnership. And so that gets us to our first slide. So as most people know, the corporate income tax rates dropped from a maximum tax rate of 35% to a flat tax rate of 21%. And in connection with that, the new Tax Act includes a Section 199A deduction. And the purpose of this deduction was to try to create some parity for people that were conducting business not through a corporate form. In other words, people who are conducting businesses through partnerships, S corporations, and sole proprietorships. It's a very complicated set of rules with a lot of exceptions and formulas, and we'll touch very briefly on them. But one thing to bear in mind is this new deduction sunsets at the end of 2025, so it is not a permanent change. And the deduction will vary greatly depending on the taxpayer themselves. And so it depends on what they do and the amount of their taxable income. So the key is that you have to have a quote-unquote qualified trade or business, and the deduction is based on the income from that business. And not all businesses are treated the same. So there's limited applicability for this deduction on certain types of quote-unquote specified services, and those are businesses that are engaged in consulting businesses, legal services, accounting services, medical services, investment management services, and things where the business relies on the reputation or skill of a person or persons. There is some deduction available, but it's limited. And basically, the phase-out starts at $315,000 and basically is gone by $415,000 for joint filers. There are types of businesses that have been treated very well for purposes of this deduction, and that's basically the real estate area. There's the full deductions available to the extent that it works out when you calculate them. And dividends from REITs and from qualified publicly traded partnerships are also not subject to some of the caps that we'll get to in a second. So as this chart tries to summarize in one slide, it's a very complicated formula. You have to do actually 3 steps to calculate this. But basically, the deduction is limited to 20% of your taxable income from a qualified trade or business or specified service to the extent limited, less your net capital gain. That's the cap. That's not actually the deduction, which could be much less because they carve out certain types of things, and they also have a separate cap based on W-2 income. So it gets really complicated, but at the end of the day, again, the idea was supposed to be to to give a deduction for people that are conducting businesses through non-corporate form to try to get some parity with the lowered corporate tax rate. So another area of change in the partnership area is a new withholding tax. So under the law, as before tax reform, non-U.S. persons were subject to tax on effectively connected income, which is also referred to as ECI. And the idea was that typically if you sold a partnership interest that of a partnership that generated ECI, you would also be subject to tax on the gain from that sale. Well, the new Tax Act makes very clear that the gain on the disposition of a partnership interest is subject to U.S. tax if it's to the extent it's attributable to a U.S. trade or business of that partnership. Now, most people would think, well, why is that important to us? That's really an issue only for non-U.S. sellers, but it is important because now there's a withholding tax. So basically, if you are a seller to a non-U.S. person of a partnership interest, and that partnership conducts a U.S. trade or business, there is an obligation to withhold. That withholding is at 10% of the purchase price, so it's a gross withholding tax. It is not based on the net gain from the sale. And it applies to partnership interests in both U.S. partnerships and non-U.S. partnerships. The only way to get out of it is if you get a certification from the buyer that they're, from the seller that they're not a non-U.S. person, in other words, that they are a U.S. person, or you somehow are able to get information from the partnership that they do not conduct a U.S. trade or business, which, as you can probably imagine, is complicated. If the buyer fails to withhold, then the partnership then is obligated to withhold on future distributions to the buyer in an amount equal to the amount that should have been withheld by the seller. There's no de minimis rule, and so this is something to think about if you are selling partnership interest in a secondary market of interest in your funds. It's also something to think about when you are looking at new partnership agreements in funds that you're going into. There may be new language in there that provides for this withholding, provides for escrows, provides for some kind of certification to make sure that the withholding does not apply. So the next set of slides turns more towards compensation and related issues that may come up. The first one, as everyone's probably heard, all throughout the last couple of years, there's been a big focus on carried interest. Well, there is a new carried interest provision. It's pretty watered down, and it comes in the form of a holding period requirement. So basically, the new act imposes a 3-year holding period requirement if you want to get long-term capital gain from your partnership interest. If you fail to meet this 3-year holding requirement, then the gain is treated as short-term capital gain, and it's taxed at ordinary income rates. Before this new law, all you needed to do is hold your partnership interest for a year. It was a 1-year holding period to get to long-term capital gain. What's important to note is that there's no grandfathering for existing interest. So this kicked in right away and became effective. It doesn't apply across the board. Again, the focus was supposed to be on carried interest. And so it's only on what's called applicable partnership interests. And those are basically partnership interest or profits interest is what we generally refer to them as, that are transferred or held in connection with the performance of substantial services in a trade or business of raising or returning capital and investing in or disposing of or developing securities, commodities, debt instruments, options, derivatives, real estate held for investments or interest in partnership to the extent the partnership's interest has the foregoing types of assets. And so this is going to apply to, private equity funds and potentially hedge funds, though the way hedge fund compensation works, it may not be a big deal there. Generally, though, the rule does not apply to operating companies. And there is a special rule for employees of operating companies that basically exempt them from this rule. So if you have an employee that's engaged in an operating business, then the 3-year holding period would not apply to them. But if you have a manager that's not directly engaged in the operating business, but instead is serving only in the management function of the fund and therefore one of these applicable partnership interests, it would be applied to them. So again, you could have different applicability of the holding rules to people that hold these types of interests. The 3-year holding period applies not only with respect to the partnership interest held by the taxpayer, but also applies at the partnership level to the partnership selling assets held by the partnership. There are exceptions. Interests of partnerships held directly or indirectly by a corporation do not apply. For a while, people were hopeful that S corporations could qualify under this rule and be accepted out of this 3-year hold period, but the IRS just issued a notice late last week forecasting some regulations that will make it very clear that S corporations do not qualify. The 3-year hold period also does not apply to what we normally think of as capital interest. In other words, to the extent that you have management teams and fund managers putting in capital in exchange for a true equity interest in this 3-year hold period does not apply to those. So why is this important to investors? Well, it does create less alignment with their managers because the managers are going to be now focused on this 3-year hold period, which will affect how long they decide to hold assets, typically at the fund level or the partnership level. So another change that came in, Charles earlier talked about limitation on a compensation deduction for publicly traded companies to the extent that the compensation is in excess of $1 million for certain highly paid individuals. This rule has been expanded under the new act. The base for the $1 million cutoff has been expanded to include options and other performance-based compensation. Additional information was provided about who is going to be within this covered employee pool that's tested. And so, again, they spell out that it will be principal executive officers, principal financial officer, and other 3 highest compensated officers. People will basically report on the proxy statement. And again, as Charles mentioned earlier, under the excise tax rules for tax exempts for 163(2)M, once you're a covered employee, you're always going to be a covered employee and caught up by this set of rules.
One thing that is important about this provision is that it applies to public companies. And whereas this provision was in effect prior to the Tax Act, there were lots of exceptions that were applied. For example, if you gave your CEO options or you gave them other types of performance-based compensation, you would not have to pay the tax on that. Those exceptions have been removed in this bill. How does that affect public companies? Well, if you pay your chief executive $20 million a year, this rule does not affect the chief executive. It does mean that the public company itself is not going to be able to deduct that compensation. Who does that affect? It affects the shareholders. This is meant to limit the amount of compensation to officers of public companies. It's not clear that it's done that in the past. Yet to be seen if it's going to do that in the future, given the fact that it's a much tighter noose that applies to these provisions now.
So the next slide talks about something that people are struggling with because there's inconsistency with the new provision that's come through with an existing provision in the tax code, and this relates to patents and inventions. So under the Act, they basically put out a new rule that basically says if you have a patent, invention, model, design, secret formula, or process, and you created it or you contribute it to a corporation or a joint venture entity or a partnership such that it's a tax-free transaction and there's a substitute basis, then the new provision provides that that asset is excluded from the definition of a capital asset, which, coming from that means that if it's not a capital asset, then on a sale you can't get capital gains treatment. And that would be problematic. I mean, it would change the way inventors and people who have this kind of IP would consider the tax effects of an ultimate exit. The challenge is that the existing provision in the tax code, which is section 1235, was not changed. And 1235 does provide that gain from the sale of a patent by an individual who created the patent does qualify or could qualify as long-term capital gains. So it's uncertain how these two provisions now interact, and therefore the tax consequence of creation and development of patents and inventions might play out.
Okay. Now we'll spend some time talking about the taxation of operating companies. And specifically, the way that the interest deduction has changed, the way depreciation has changed, and the way that the net operating loss rule has changed. And all of these interact, I think, in ways that are very important for people that are investing in both public companies and in private companies held through private equity entities. I mentioned before that throughout the changes that are made by the new Tax Act, that you treat different transactions, different taxpayers differently, and the effect of the provisions change over time. And the new rules on interest deductions highlight those features of the new Act very well. Now, interest deductions for taxable entities, including corporations and individuals, are limited to 30% of adjusted taxable income. Excuse me. Now, what is adjusted taxable income? Adjusted taxable income is taxable income determined without regard to interest, the net operating loss deduction, and the Section 199A deduction, which is the special deduction for income earned through partnerships. Now, in years before 2022, adjusted taxable income is calculated without regard to depreciation or amortization deductions. So again, as the headline here says, you're limited to 30% of EBITDA prior to 2022, and after that, EBIT. There's no grandfathering of previous transactions. Again, this shows that this change was inserted in the law to make it more efficient from a revenue loss standpoint. I think that initially this was limited to EBITDA, which would allow for more interest deductions, but in order to meet the revenue estimates, it was changed to include only EBIT after that date. Now, again, there are certain businesses that are not subject to these rules. Real estate businesses, as is the case in the special 199A deduction that applies to individuals. Real estate is specially treated. Small businesses are also not subject to this rule. Those are average gross receipts in the prior year of $25 million or less. So these are some fairly significant smaller businesses that are not subject to these rules. Farm businesses are not subject to the rules, and also motor vehicle, boat, and farm equipment dealers for floor plan indebtedness. These folks were very active in lobbying on this issue, and they were successful, obviously. One thing that is important to realize on this is that heavily leveraged businesses are able to take to not be affected by this. So that, for example, if you have a lot of interest expense and a lot of interest income, you are able to claim those deductions. Now, interestingly, from a tax policy perspective, unused interest deductions are carried forward and can be carried forward indefinitely. They're treated as incurred in the next year. Now, they're not part of your net operating loss deduction as they are under current law. Under current law, you look at all your deductions and aggregate them and then carry them forward or carry them back. Here, you have to maintain a record of your unused interest deductions and your net operating losses, which are treated as separate. The unused interest deductions are subject to limitation after a sale of the business, the same way that net operating losses would be. And another complex aspect of this is that the limitation applies at the partnership level. So to the extent you have a partnership that has that's engaged in a business that's subject to this rule, it does not apply to real estate businesses as long as you make the appropriate election. You have to determine the limitation at the partnership level. And there are very complex rules in terms of allocating that to the partners. Why is this important? This provision will potentially impact private equity portfolio companies. And it's going to impact private equity managers that use quite a bit of leverage. And I've talked to a number of private equity managers about this, and they generally say that it will not affect them, but they think it will affect the other guy. I think it's just important that to the extent that you have investments in private equity that you inquire about quite your managers about how this will affect them. And they may be in a position where their interest expense is not this is not going to be problematic for them. But it is, I think, something that should be looked into whenever you're investing in private equity. Now, the other important provision in this that interacts with the limitation on the interest deduction is that net operating losses are limited to 80% of taxable income and may not be carried back. They can, however, be carried forward indefinitely. And these changes are effective for losses arising in taxable years after 12/31/17. So to the extent you have a portfolio company or a public company that has losses as of the end of last year, those can be carried forward and used without limitation. Again, that's a sort of a strange result, but again, it's driven by revenue consideration. This interacts with the new rules on expensing of capital assets. And again, these are very complicated provisions. There are a couple of them. One, there's a provision that allows small businesses to expense up to $1 million a year of otherwise depreciable assets. This is a permanent change. And it's very important for a lot of smaller businesses because you have to have more than $1 million a year of capital expenditures in order not to be subject to this. And this is a big deal for these small businesses. Now, in addition, 168K, which provides for bonus depreciation, has been changed to allow for increased depreciation deductions. And this is a provision that is currently applicable, but it phases out over time. Now, through 2022, 100% of the cost of tangible personal property may be deducted as a bonus depreciation in the year such property is placed in service. Now, this percentage is reduced by 20% every 2 years under 2027 when this terminates. Now, any cost not recovered by the bonus depreciation is written off under the regular maker system. Now, this also applies to bonus depreciation. The new rules apply to used property, which is very important for people that are buying and selling businesses. This was not the case before. So that under the new rules, if you as a private equity manager manage to buy the assets of a business, you can, if you wish, write that off immediately. And we'll talk in a second about why you may not want to do that. In that the net operating loss rules may be a discouragement for that. So, for example, if I buy a business and I get a huge depreciation or bonus depreciation deduction, if that exceeds my taxable income in the year that I buy the business, I'll carry that forward as a net operating loss. Now, as we talked about, I'm only going to be able to use 80% of that against my taxable, against 80% of my taxable income. So getting all this bonus depreciation in the first year that I make the investment is probably not going to be that useful for a lot of people buying in businesses and operating them. Who then is going to benefit from this? I think that what you may see is this may be of interest to taxpayers that who have a big spike in income and who want to shelter that income in 1 year. So that, for example, you might have a taxpayer with a big income item who goes out and does a sale-leaseback with someone, and that will generate the deductions that will enable them to shelter that income. So it's very important to think about the interaction of the net operating loss rules, these interest deduction rules, and the new expensing rules. I think that taxpayers will be doing a lot of projections to try and even out their deductions so they do not get into a situation where they just generate a bunch of losses in 1 year and carry them forward. So this will involve a lot more complexity in how people are looking at their taxable income. It's also going to encourage people to look at other types of what they call tax-efficient transactions to try and eliminate the tax on spikes of income. So we're going to talk for a few minutes about the international provisions. And the slide deck goes into these provisions very much in depth, but I'm just going to talk real quickly because we're getting to the end of our presentation about the most important high-level points in these provisions. And there are about three major issues. The first is that under prior law, if I conducted business through a foreign corporation, if I'm a U.S. public company or U.S. individual, the income derived by that entity was typically not taxable until it was distributed to me. So that if, for example, I was a large IP company in the U.S., I would put my intellectual property in a foreign corporation and derive income from that in that foreign corporation. And I would essentially keep that income offshore until I was repatriated. And there were various things I could do to get the benefit of that. But generally, I would keep it offshore. Under some estimates, there were $2 to $3 trillion kept offshore by large U.S. public companies. What the new tax bill does is it provides that all that income that's been kept offshore, well, it's going to be subject to tax, and it's subject to tax. It was subject to tax last year. Now it's subject to tax at a preferential rate. The tax rate is 15% on 15.5% on income that was held in cash, which actually a lot of this income was, and 8% on income that was reinvested offshore. Importantly, that tax is payable over an 8-year period if the taxpayer elects. So the income that was held offshore for so many years, has been subject to tax, but it has been taxed at a very low rate. And again, this has been well publicized. A lot of that income is being brought back, and a lot of it is being used to, in many cases, do stock buybacks. Some very large portion of it has been used in that way, or will be used in the future. Now, going forward, the income that is derived offshore in this manner is subject to new rules called the GILTI provisions. And those are described further in the presentation. But essentially, you're not able to use those kinds of structures anymore. Income like IP income that's derived offshore and not subject to tax offshore will be taxable in the U.S. under those provisions. Again, the tax rate is a preferential rate. You don't pay the full corporate rate of 21% on that. The fact that there's no more deferral of that income is a sea change in the way that earnings are taxed. Now, there are certain exemptions to that. There's a participation exemption for dividends, and the first 10% of earnings on your tangible assets offshore are not subject to this provision. But given that so much of the offshore income is intangible, effectively that income is going to be brought back to the U.S. The second thing that has changed is that exports are now subject to a preferential tax regime. And that is if I license intellectual property out of the U.S. or I sell product outside the U.S. to unrelated persons, that income is taxable at a much lower rate. These are called the FDII rules. And you get a significant deduction on that. It's 37.5%. Again, that's reduced after 2025 to 21% and change. Again, there are export incentives that have been created for U.S. companies that sell outside the U.S. It's yet to be seen whether this will have the desired effect. People have complained that the deduction is not high enough to provide the appropriate incentives. But I have talked to other foreign investors who have started looking at the U.S. as being a very interesting place to put their money, both because of the lower tax rate, the 21% tax rate, and because of these new FDII rules. The final thing that I think is very important in the international side is sort of the expansion of the types of entities that are subject to these deemed repatriation rules. The rules on what are called controlled foreign corporations have changed. There's a much broader type of company that can be subject to these rules. So it looks like we're getting to the end of our presentation. So I will be happy, and Wanhan will be happy, to take any questions from the audience.
Great. Thank you, Charles. Thank you, Wanhan. So a question we have is public pensions as limited partners. Should they be expecting revised terms from their GPs, general partners? And if so, what are the particular areas that we should be looking out for?
I think we have not seen anyone revising their agreements yet. There are two things that you may be seeing going forward. The first is that general partners may be trying to restructure so that they can get advantage of the 20% rate. That would involve them potentially taking interests in the operating companies as opposed to having carried interest out of the fund. If there are changes in this regard, they will be fairly complex. Other than that,
So just to chime in, so as Charles is right, so to the extent that these new regimes are figured out, these new rules are figured out, it would change the overall structure of the investments. In other words, as you know, probably see in a lot of the fund documents, there's a lot of flexibility for the general partner to create AIVs, to create subsidiaries, to create all kinds of things below the fund. And that's probably where a lot of the give is going to be, because the GPs, and we've been seeing more and more of this language in the partnership agreements that provide that the GP can take carry at the fund level, or they can take carry at some lower level as long as it's not more or any earlier than they would have gotten from the fund. That might be where the GP starts to use the ability to maybe take in-kind things so that they can take different kinds of interest to take advantage of some of these rules and lower tax rates. But other than that, I don't think the overall economic packages that are being offered are going to change. At least we haven't seen it so far. As a lot of the investors have seen, typically whenever you're going into a new fund or you're re-upping an investment in an existing manager, the LPAs change a lot. The ones that we've been typically seeing relate to the new partnership tax audit rules that came into play on January 1st. Fund agreements continue to get massaged for the manager fee waiver provisions. We see that. We also have heard from the IRS that the agents are being told to take a hard look at management fee waivers to make sure that they're consistent with the proposed regs that came out in the summer of 2015. Those are the areas where we see the most of the rewrite in the partnership agreements. But the economic terms so far, we haven't seen much movement. But again, it's a whole new world out there.
Yeah, one thing that will be, I think, very interesting for managers is that is perhaps not investing through corporations, but investing through LLCs. Now, that doesn't change the terms of the agreement, but it does change the way that these entities look. And why would that be of interest to them? Well, one, the potential of getting the benefit of the 20% deduction. Secondly, to the extent that you have limitations on your interest deductions and you have a significant amount of public pension investors, the limitation on interest deductions becomes less of an issue. And again, this assumes that we maintain the UBIT exemption for public pensions.
Great. And then probably just the last question. What areas of the tax bill do you think are the most ripe for technical corrections? And are there any provisions that would impact public pensions?
Charles and I are laughing because we can't think of one section that doesn't need some fix.
The thing I mentioned at the start is where farmers are exempt from tax on amounts that they sell to co-ops is one that has been talked about as definitely needing a technical correction. In terms of the technical corrections that would apply to pension funds, it's hard. It's hard for me to think of any specifically, except insofar as they're making investments. I do think that there's going to be some sort of clarification on how personally developed intellectual property is treated. So I think that might be another area.
So the other area, too, that comes into play a lot in investments is the interest deduction limitation that we talked about. And there's not a lot of certainty about how the deduction works when you're doing debt at a lower level and it flows through a partnership. So there's a lot of questions about, how it works when you have different partnerships with different AIVs and you split things up and then they come back together. So that's an area where people are looking for more information. The other thing that has a lot of complexity is and we didn't touch on it very deeply, was the new Section 199A deduction for pass-throughs. How do you figure out what's a trade or business? It all seems so simple, but when you look at the rules, there's a lot of carve-outs and inconsistent languages and how it plays when you have tiered structures. So there's a lot of areas out there that need a lot of work. And we've listened to a couple panels where either representatives from the Treasury have been present or the IRS or some combination thereof. And, they're busy and obviously understaffed, and they have a whole list of things that they know they need to get to. And one representative seemed to imply that they have a list that they're trying to target in the next month. And one of those is the carried interest, guidance on the carried interest, which they, again, came out on last Friday to say that they're putting out regulations on that one. They have a 1-month list, a 2-month list, a 6-month list, an 18-month list. So they have, they're trying to rank what they need to get to first, and there's quite a bit.
Yeah. No, and let me just, one other point is that the international provisions are going to be ripe for lots of technical corrections because they are very unclear and complicated. Anyway.
Great. Juan, Charles, thank you so much. And I also want to thank the participants on this webinar. At the conclusion of this webinar, there will be 3 short survey questions that we will ask you to answer. And we look forward to hosting the next webinar on March 13th on OPEB statements. So thank you all, and we look forward to seeing you again later this month. Thank you.
Thank you.
Thank you.